You know those moments, maybe late afternoon, feeling a bit stressed, and suddenly that craving hits.
Yeah,
Whether it's an Oreo, maybe a Ritz cracker, or a Cadbury bar, these aren't just snacks, are they? They're kind of woven into our daily lives.
they really are.
But have you ever stopped to think about the massive financial forces that are shaping what actually ends up in your snack drawer?
That's exactly what we're digging into today. Welcome to the deep dive.
Right.
We've been looking closely at the latest financial health of one of the biggest global snacking giants out there, Mondelēz International.
And for this,
Hmm?
we're using their freshly released second quarter 2025 results press release, and also that really detailed Q2 2025 10Q filing.
Both just out on July 29th, 2025, hot off the press.
So our mission here is to cut through all the corporate jargon, unpack these reports, and pull out not just the facts, but, the interesting insights and maybe some surprises.
Yeah, help you understand not just what happened with Mondelēz, but why it matters for a company that, well, touches so many households around the world.
Exactly. So let's peel back the wrapper on these numbers. Where do we begin?
Okay, let's start with the top line performance. That gives us the first snapshot of their revenue growth.
Right.
So Mondelēz reported net revenues up 7.7% for Q2 2025 compared to last year.
Okay, 7.7%.
But maybe more telling, their organic net revenues, which, strip out things like acquisitions and currency fluctuations to give a clearer picture, those were up a pretty healthy 5.6%.
That does sound pretty solid. But what immediately jumps out at me is that their volume mix actually saw a slight decline. It was down 1.5%.
Mm-hmm.
So for our listener, volume mix basically means they're either selling fewer actual snacks or maybe people are shifting towards less expensive items.
That's right. Fewer units or a shift in what kind of units.
So how does that work? Revenue's up, but volume's down. It seems a bit contradictory.
Well, it's a classic case of pricing power in action. Dirk van de Put, the CEO, he actually talked about this. He mentioned accelerated top-line growth and pointed specifically to strong pricing execution, especially in their chocolate business.
Okay.
And he noted robust growth across most geographies, despite what he called a challenging environment. He sounded pretty confident.
So basically, price increases are more than making up for the fact they're selling slightly less stuff.
That's the long and short of it, yes. Strong pricing is the key driver here.
Okay, and I think this is where this story gets really interesting, because that overall picture, it hides some pretty dramatic differences depending on where you look.
Absolutely. Regionally, it's quite varied. Take Europe, for instance.
Yeah.
It just exploded.
Yeah.
Strongest reported net revenue growth, soaring 18.7%.
18.7%. Wow.
Yeah, and even organically, it was up 12.5%, a huge surge.
So were Europeans just suddenly eating way more chocolate and biscuits?
Well, not exactly. That growth wasn't really about volume. It was almost entirely driven by significant pricing actions. Pricing accounted for a massive 13.8 percentage points of that growth. Volume mix, actually, it declined slightly by 1.3 percentage points.
So people paid more,
Yeah.
but bought a tiny bit less. What did that suggest? Strong brands.
It really suggests remarkable brand loyalty in Europe, I think. Even with significantly higher prices, consumers seem to be sticking with their favorite Mondelēz brands. It shows they can pass on costs pretty effectively there.
Okay. And then we shift over to Asia, Middle East, and Africa. AMEA. How did they do?
AMEA also delivered really strong numbers. Reported net revenues were up 14.7%.
Also very strong.
And organic growth was a robust 8.6%. But what's particularly interesting here is that AMEA actually managed positive volume mix. It was up 0.7 percentage points.
Oh,
And that was alongside strong pricing, which was up 7.9 percentage points.
so they're selling more and charging more. That's kind of the dream scenario, isn't it?
It really is. That's an enviable position. AMEA looks like a real dynamic growth engine for them.
Okay, but then Latin America sounds like it was a bit different.
Latin America presents let's say, a different kind of challenge. It saw a reported net revenue decline of 3.1%.
A decline. Okay.
But organically, stripping out currency and other factors, it actually grew by 5.4%.
Right, so how does that work?
The key there is extreme pricing. Pricing added 7.6 percentage points to growth. You have to remember, this region includes places with very high inflation, like Argentina.
Ah, okay, so they're pushing prices way up to keep pace.
Exactly. But consumers are clearly feeling that pinch. The volume mix there declined by 2.2 percentage points. So it's a real balancing act trying to maintain revenue in these highly volatile economies.
That makes sense. You have to adjust aggressively. And then we get to North America. which really stands out as the outlier here.
It really does.
Yeah.
It was the only region to see a reported net revenue decrease, down 3.5%.
Wow.
And negative organic net revenue growth, too, minus 3.4%. Both volume mix and pricing were actually down.
Both down. What happened there?
Well, the report specifically mentions a couple of things. One was U.S. retailer inventory destocking.
Meaning retailers were selling off old stock, not ordering new.
Precisely. Clearing the shelves rather than refilling them in the short term. And the other factor was soft consumption, particularly in biscuits and baked snacks.
So demand weakened a bit there. Okay, so if you put all these regions together, what does this tell us about the sort of fundamental differences between developed and emerging markets for a company like Mondelēz?
Well, if we zoom out a bit to that broader picture, emerging markets, places like Latin America, parts of EMEA, Eastern Europe, they saw impressive organic net revenue growth overall, 10.2% in Q2.
10%.
And that was overwhelmingly driven by pricing, which was up 11.0 percentage points.
Right.
Now, compare that to developed markets, North America, Western Europe, Australia, places like that. They had much more modest organic net revenue growth, only 2.7%.
Big difference.
Yeah, and pricing there contributed less, about 4.5 percentage points. So it highlights this really fascinating strategic split. Well, in emerging markets, there just seems to be more room or maybe more necessity for these big price increases, perhaps due to higher inflation or just different consumer dynamics.
Right.
Whereas in developed markets, consumers are maybe more sensitive to price hikes. The markets might be more saturated. So growth is just tougher to achieve, especially if your volumes are actually falling, like in North America this quarter.
So it's not just about raising prices everywhere. It's about where you can actually make it stick and what that says about your brand strength and how mature the market is.
Exactly. Pricing power varies significantly.
Okay, so while that top-line revenue shows some impressive pricing, that's really only half the story, isn't it?
It really is. The real test is always what's left after you account for all those rising costs.
The bottom line.
Exactly. So let's switch gears to profitability because that tells a very different and frankly a more challenging story this quarter.
Okay.
While their reported diluted EPS, earnings per share, that actually increased 8.9% to $0.0849.
Which sounds good.
Right. But their adjusted EPS, and this is a non-GAAP measure management, uses to give a clearer view of underlying performance, stripping out volatile items. That actually decreased quite significantly. It was down 14.5% on a constant currency basis, landing at $0.71.
Okay, wait. Reported up almost 9%, adjusted down over 14%.
Yeah.
That's a huge difference. It really shows why looking at those adjusted numbers is so important.
It's absolutely critical for understanding the core operational performance, and it wasn't just EPS. Their adjusted gross profit margin also took a really big hit.
How big?
It fell by 680 basis points. That's 6.8 percentage points, down to 33.7%.
Ouch. 6.8 points off the gross margin. What drove such a steep decline?
The main culprits were higher raw material costs. Think cocoa, sugar, energy, and also higher transportation costs.
Okay.
That was compounded a bit by what they called an unfavorable product mix, so maybe people buying slightly less profitable items.
Got it.
And these big headwinds were only partially offset by the higher pricing we talked about and some cost savings they found in manufacturing.
So pricing helped, but didn't cover everything.
Not nearly. And you see that flow through to their adjusted operating income, too. That decreased 14.0% as reported, or 16.0% on a constant currency basis, down to about $1.3 billion.
16% drop in operating income, constant currency. What were the biggest drags there?
Well, the single biggest factor in constant currency terms was a staggering $860 million negative impact just from higher input costs.
$860 million, just from input costs.
Just from input costs. Plus, the unfavorable volume mix we discussed earlier chipped away another $129 million.
Wow.
Now, they did get some benefit from the higher net pricing, about $589 million positive impact, and they cut some selling, general, and administrative costs, which helped by about $141 million.
But clearly not enough to overcome that massive $860 million hit from input costs.
Not even close.
And the report specifically calls out cocoa, right? It says their whole 2025 adjusted EPS outlook, expecting about a 10% decline, is primarily due to unprecedented cocoa cost inflation.
Yes. Cocoa is the big one right now. It's not just a general cost issue for them. It's a specific, enormous challenge hitting their chocolate business particularly hard.
So how does a giant company like Mondelēz even try to manage something like cocoa prices going through the roof?
Well, They tackle it with a few tools. The main ones are hedging, trying to lock in prices in advance through contracts.
Right.
Then there's passing costs on through higher pricing on their products, which we've seen they're doing aggressively where they can.
Yeah.
And finally, really rigorous control over their manufacturing and overhead costs, trying to find savings wherever possible.
But I guess hedging isn't always foolproof.
No, and they admit that. They say full hedging isn't always possible for certain commodities. They mentioned dairy as an example. And sometimes pricing actions can lag behind how quickly these input costs are actually rising. So it's like a constant race.
Sounds like a game of whack-a-mole with global commodity prices.
That's not a bad analogy, actually.
And thanks for explaining those adjusted numbers earlier. It's such a good reminder that those non-GAAP figures, while you have to be careful, they really do add that extra layer of insight when you're digging into the details.
They do. Management uses them internally for decision-making, so they reflect how they see the underlying business performing. You just have to consider them alongside the official GAAP numbers, not instead of them.
Right. Okay, so moving from profits on paper to actual cash in hand.
Yeah.
Because, cash is king.
Always. So year-to-date, cash provided by their operating activities was $1.4 billion.
$1.4 billion. How does that compare?
Well, that's actually down quite a bit from $2.1 billion in the same period last year.
Okay.
And their free cash flow, which is operating cash minus capital expenditures, came in at $0.8 billion for the first half.
So quite a noticeable drop in the cash they're generating from just running the business. What's driving that reduction?
The report points to two main things. Lower cash basis net earnings, which makes sense given the profit pressures we just discussed,
Right.
and also higher year-over-year working capital movements.
Okay, can you quickly break down working capital movements for us? What does that mean in simple terms?
Sure. Think of working capital as the money tied up in the day-to-day running of the business. It's things like inventory, the snacks waiting to be sold,
Okay.
accounts receivable money customers owe them, and accounts payable money they owe suppliers.
Got it.
So higher year-over-year working capital movements typically means more cash is getting tied up in these things compared to last year. Maybe they're holding more inventory, or perhaps it's taking longer to collect payments from their customers. Either way, it reduces the immediate cash available.
That makes a lot of sense. So less cash coming in the door from operations right now. But despite that, Mondelēz still returned a pretty substantial amount to shareholders, didn't they?
They did, a very substantial $2.9 billion in the first half of 2025 alone.
$2.9 billion. How?
Through a combination of cash dividends paid out to shareholders and buying back their own share repurchases.
And they're signaling more of that, right? I saw they announced a dividend increase.
That's right, a 6% increase to their quarterly dividend. It's now $0.50 per share, payable in mid-October.
That feels like a strong signal of confidence, doesn't it? Raising the dividend even when costs are squeezing profits and cash flow is down year over year.
It absolutely is. It shows a strong commitment to returning capital to shareholders and suggests they believe the current pressures are manageable long term.
And they didn't stop there with shareholder returns, did they?
No, the board also approved a brand new, very large share repurchase program. It authorizes them to buy back up to $9.0 billion of their shares between now and the end of 2027. That replaces their previous program.
$9 billion. That's a lot of shares. So looking ahead, what are they projecting for cash flow for the full year?
They're expecting 2025 free cash flow to be $3+ billion, so over $3 billion.
Okay, so they expect a much stronger second half for cash generation.
Seems so. And they generally fund their needs, both short-term operations and long-term investments, primarily with cash from operations and debt financing. They don't typically issue new shares, new equity to raise cash.
Right. And speaking of investments, they're spending quite a bit on future growth, too. Capital expenditures.
Yes, they're planning for capital expenditures of up to $1.3 billion in 2025.
$1.3 billion. What's the focus of that spending? Where's the money going?
It's strategically aimed at a few key areas: modernizing their existing facilities, setting up new manufacturing capabilities, probably for new products or growing categories, and generally driving productivity initiatives across their global operations.
So investing in efficiency and future capacity.
Exactly. It's about shoring up the foundations for the long term.
Okay, let's maybe zoom out again and talk about the bigger picture, the operational and strategic landscape. Because Mondelēz operates in this really complex, often unpredictable global environment.
That's putting it mildly sometimes.
The report keeps mentioning greater than usual volatility. Cites things like geopolitical, trade, and regulatory uncertainty and commodity prices.
Hmm.
What are the sort of ongoing real-world challenges they're wrestling with day to day?
Well, the big one we keep coming back to is significantly higher operating costs. That includes raw materials like cocoa, but also labor and energy costs across the board.
And this directly ties back to the pricing actions we talked about earlier.
Absolutely. Those price increases are, in large part, a necessary defensive move to try and offset these rising input costs that are hitting their margins so hard.
But they're not just reacting, are they? They're also making some pretty big strategic bets on the future. That ERP system implementation really caught my eye.
It's a huge undertaking. This is a multi-year program, $1.2 billion, approved back in July 2024.
$1.2 billion.
Yep.
Hmm.
The goal is to completely overhaul their global ERP, that's enterprise resource planning, and their supply chain systems. They expect it to be fully rolled out by the end of 2028.
Wow. So this isn't just like updating software. This sounds fundamental.
It really is. It's a foundational investment. They're aiming for long-term operational efficiency, much better data insights across the whole company, and building a more resilient global supply chain. It's massive.
And they're still doing acquisitions too.
They've been strategic there. For example, they acquired a company called Everth Industrial in Shanghai back in November 2024.
Everth, what do they do?
They're in the cakes and pastries business in China. So that acquisition is clearly aimed at expanding Mondelēz's growth in that specific category and market. It shows
Yeah.
their strategy, find consumer trends, find market opportunities, and buy the right assets to capitalize.
Makes sense. The report also touches on some incredibly sensitive geopolitical stuff. Let's start with the war in Ukraine. What's their situation there operationally?
Well, Mondelēz states they actually fully resumed production at 2 facilities in Ukraine that had been damaged. That was back in Q2 of 2024. So that shows some serious resilience on the ground.
That's quite something. And what about Russia?
It's complex. They state they've suspended new capital investments and advertising in Russia. However, they have not ceased operations there.
Why not?
Their stated reason is their role in maintaining food supply. And Russia is still a significant market for them. It generated 4.0% of their total consolidated net revenue in this past quarter, Q2 2025.
4%. So it highlights this really difficult position for a global food company, right? Balancing ethical considerations, global responsibilities, local operations, employee safety, all in a war zone or sanctioned country.
It's an incredibly complex tightrope for any multinational operating in those kinds of zones, a huge challenge.
And what about the conflict in the Middle East? Did that have an impact?
They mentioned experiencing limited adverse sales impacts in certain markets within their EMEA region due to the conflict. However, they said it had no material impact on their overall business results for the quarter.
Well, they're watching it closely.
Absolutely. They emphasized they're constantly evaluating potential future impacts. You have to in this environment.
So with all this volatility commodities, geopolitics, how does a company like Mondelēz manage the financial risks involved? They mentioned using derivatives.
That's a core part of their strategy, yes. They use derivative instruments, financial contracts, to try and reduce the impact of big swings in things like currency exchange rates, commodity prices like cocoa, and interest rates.
So trying to lock in prices or rates to create more certainty.
Essentially, yes. Hedging against volatility. They also manage their liquidity and working capital partly through something called a supply chain financing program.
Supply chain financing, how does that work?
Basically, it's a system set up, usually with banks, where their suppliers can get paid earlier than the standard payment terms. Mondelēz confirms the invoice is valid, and the supplier can get the cash sooner from the financing provider.
Okay.
As of the end of June 2025, Mondelēz had about $3.7 billion in outstanding obligations confirmed under this program. It helps their suppliers with cash flow, and it can help Mondelēz optimize its own payment terms and working capital efficiency.
Interesting. Okay, finally, let's touch briefly on human capital and governance. The report mentions a new global employee stock purchase matching plan.
Yeah, that just became effective in May 2025. The idea is really to get employees more invested, literally, in the company's long-term success.
How does it work?
It allows participating employees to buy Mondelēz shares through regular payroll deductions, and the company provides a matching contribution up to 25% of what the employee contributes.
So encouraging employees to become long-term shareholders, aligning interest.
Exactly. They also briefly mention a severance plan for key executives, which is pretty standard practice for attracting and retaining top management talent.
And anything else on the governance side that signals stability?
Well, one thing they note is that they have a covenant basically a requirement in their debt agreements, to maintain a minimum level of shareholders' equity, $25 billion, excluding certain items. And they state they are in compliance with this, which is a good sign for overall financial stability.
Okay, so let's try and wrap this up, bringing our deep dive into Mondelēz International's Q2 to a close. What are the main takeaways?
Well, I think we've seen a company that's definitely driving top-line growth, largely through some pretty bold strategic pricing, especially in Europe and the AMEA region.
Right, but that pricing seems absolutely necessary to battle these really significant cost inflation headwinds, particularly from cocoa right now.
Exactly. And they're doing this while navigating some very complex geopolitical uncertainties, showing resilience, particularly in places like Ukraine.
And at the same time, they're making these huge long-term investments in operational efficiency, like that massive ERP system overhaul.
Yep. And importantly, they remain very committed to returning substantial capital to shareholders through dividends and buybacks, despite the current pressures.
It really paints a picture of a giant trying to balance a lot of competing forces.
It really does. For you, the listener, what's clear, I think, is that these global giants like Mondelēz, they operate in this incredibly complex financial world now. They're constantly juggling consumer demand, these volatile commodity costs, and just ever-shifting global events.
Exactly. And it kind of leaves you with a final thought, doesn't it? We've seen unprecedented cocoa costs pushing prices up. How much more can consumers actually bear before volume starts to take a more significant hit, maybe globally?
That's the billion-dollar question.
Or, what might these financial dynamics tell us about the future of global snacking itself? Are we maybe on the edge of some real shifts in what we crave? Or perhaps just how resilient our favorite brands truly are when faced with these kinds of pressures?
Yeah, definitely a lot to mull over next time you reach for that afternoon snack.